Gold at over $4,000 is a verdict on American centrality. It reflects a world that no longer prices the United States as an unquestioned counterparty and no longer expects a rapid restoration of restraint. The dollar remains dominant by habit and infrastructure, but the habit is weakening and the infrastructure now has alternatives. Price is recording that transition and not speculating about it. After all the headlines, let's get precise about what the price is signalling. Yesterday, when gold cleared over $4,000, the move did not ask for better US policy. It assumed it would not arrive. Investors have internalized that shutdown brinkmanship, soft fiscal anchors, and institutional theatre are not anomalies to be corrected, but features to be managed. The response has been mechanical rather than emotional. Reduce exposure to a single issuer's discretion and increase exposure to neutral collateral and rewire portfolios on the assumption that dollar centrality will fade by degree and not decree. The timing is not incidental to that verdict, because when spot gold crossed $4,000, the year had begun at near $2,600, with $3,000 falling in mid-March and the next $1,000 arriving briskly within the next 2 quarters. The speed is best read not as froth, but as the market's accelerated repricing of American centrality. The inevitable comparison with January 1980 is seductive, but the mechanics differ. Then, abrupt exchange rule changes, most visible in silver, hit highly leveraged positions and forced liquidations. Today, the buyer base is built around policy objectives and longevity. Central banks operating on multi-year plans, institutions with mandates rather than adrenaline, and many households just starting to use gold as a ballast. That does not abolish pullbacks. It simply changes their meaning. A move to 3,700, even 3,500, would reflect round number psychology and year-end bookkeeping, not a reversal of the underlying shift away from single issuer dependence. If real rates are higher and gold still advances, the message is not a temporary inflation scare. It is the repricing of an order that investors no longer expect to repair itself. Markets have internalized that shutdown brinkmanship and elastic definitions of temporary and episodic pressure on institutions are not anomalies to be ironed out. They are the regime. And in that regime, the safety premium on dollar claims compresses and the neutrality premium embedded in gold widens. The demand profile confirms that this is structural rather than excitable. For a decade, attention centered on the Eastern bid, and reserve managers and households across Asia accumulated metal to build settlement optionality and reduce exposure to a single veto point. That effort has matured into architecture, alternative rails, deeper local bullion markets, and a preference for assets that sit outside foreign discretion. And the West, for different reasons, has moved from curiosity to adoption, preferring collateral that is not contingent on policy mood. This is not a trade, it is a portfolio design, and once implemented, it is sticky. A useful way to frame the change is to step away from price targets and look at the context. Consider the relationship between US gold holdings and the stock of treasuries outstanding. In the 1940s, the coverage ratio was substantial. In the 1970s, you could say it remained meaningful, and today, negligible. No one needs to predict an imminent revaluation to understand why official institutions continue to add metal. If markets ever insisted, even partially, on restoring coverage, arithmetic would do the work. This point is not one of prophecy. It's the quiet recognition that a system relying on a single issuer's restraint has chosen, in practice, not to be restrained. And here, the distinction between liquidity and neutrality is decisive. Dollar assets are liquid until a non-economic decision renders them less so for particular holders. And gold is neutral. It requires no forbearance, no clearing through an institution that can be pressured, and no alignment with a domestic political timetable. For central banks and sovereign funds that cannot control decisions in Washington but must live with them, well, neutrality is worth paying for. It is the plainest way to hedge the American policy variable without abandoning the benefits of dollar finance altogether. The broader backdrop complicates tidy narratives about risk on. Records are being set across asset classes, even as inflation is not conclusively tamed. The labour market cools, and the federal government has entered yet another shutdown. And some of that strength is abundant liquidity lifting most boats. And some of it is more uncomfortable. The same doubts that elevate gold, concern about the unit of account, and the governments around it can also inflate risk assets, making portfolios appear diversified when they are exposed to a common driver. If the driver is a reassessment of American policy credibility, then equities, crypto, and bullion can rise for the same reason, which is a warning, not a comfort. We take a technical temperature check, while they support the view that this is persistent rather than some mania. Measure gold's distance above its 200-day moving average and you find heat, but not the kind of excess that preceded previous climaxes. ETF fund inflows are notable rather than manic. Futures positioning is assertive without resembling some kind of scramble, and bubbles thrive on adoration. But this advance proceeds in the presence of skepticism, which is usually what durability looks like. The question of America sits at the center of all of this. For decades, global portfolios were built on the premise that US policy would be boring when it needed to be, that rules would outlast personalities, and that extraordinary measures would revert to the mean. The practice of the last 15 years has delivered a different lesson. Temporary tools become lifestyle choices. Fiscal anchors are honored rhetorically and ignored operationally. Independent institutions are asked to play a little more politics than their mandates imply. The world has, quite rationally, ceased to assume a quick return to an earlier discipline. It is not waiting for credibility to be rebuilt, it is reducing the need for it. So that insight recasts the meaning of over $4,000 entirely, because gold at this point is not a plea for better behavior. It is the price of a world that has stopped waiting. The process of phasing down dollar exposure is already underway, and it does not depend on speeches from Washington. Reserve managers are converting a portion of claims on the United States into assets that sit outside US discretion, and institutions are structuring portfolios that assume policy volatility is a feature, not a bug. And households? Well, they're only just wondering if something smells a bit off. The center of gravity is shifting, and crucially, it is doing so by design rather than in panic. Now, none of this implies that the dollar is disappearing or that treasuries no longer matter. Dominance fades by degree, not by decree, as was already said. Payment systems and legal frameworks don't move overnight, but marginal decisions, repeated often enough, rewire the system. A little less automatic bid at each auction, a little more tolerance for settlement in a regional currency, a little more gold on the margin of each reserve portfolio. The cumulative effect is a world in which the dollar still matters, but it shares a stage with alternatives that were quietly prepared while attention was elsewhere. The investment implications are prosaic, and in a sense, they're dull. Treat neutrality as core rather than option. Build positions and stages so that the inevitable pullbacks do not trigger behavioral errors. And if you are late, well, buy with rules rather than with emotion. And if you are heavy, distinguish prudence from panic and avoid dismantling the anchor because a candlestick looks stretched. The right mental model is not, do I chase the rally? But what proportion of my wealth should be insulated from policy variability? That proportion will differ by investor, but the principle, it travels well across everyone. The policy implications are also straightforward. Even if they are likely to be adopted, a credible medium-term fiscal framework, shutdown-proof budgeting, and statutory protections for statistical agencies and the central bank would compress the policy uncertainty premium in short order. The more realistic assumption is that they will remain aspirations rather than actions. Under that assumption, the neutrality bid persists. The trade fades, the allocation remains. For me, the conclusion is unambiguous. The world is not waiting for Washington to restore credibility. It's reducing the need for it. And gold at $4,000 is the accounting entry for that choice. The dollar will remain important, but it will share the stage with alternatives built in parallel, especially across the East, where settlement and reserve systems have been engineered with redundancy in mind. Investors who persist in treating neutrality as optional are making a bet on a reversal that is very much unlikely to arrive. Those who treat it as core are aligning with the transition that is already in motion. On one side sits a set of IOUs whose value rests on the continued self-discipline of the issuer. On the other sits an asset that does not require any such behavior. The premium between the two widens and narrows as politics intrudes or recedes. And at over $4,000, the ledger is not requesting fewer surprises. Instead, it's recognizing that surprises are the base case and pricing accordingly. Now, for those of you who prefer process to my metaphors, well, we can translate this into position sizing and stage entries and a simple discipline for buying weakness rather than chasing the heat. So book a strategy call with GoldCore, bring your horizon and your current mix of promises, and let's talk about a plan built for a multipolar reserve world, one that embeds neutrality as risk control rather than as an ideology.